My name's Dominic D'Angelo. I'm the Director of Research at O'Keefe Stevens Advisory. Today, I'm going to go over our thesis behind why we believe TopGolf Callaway is an attractive investment today. So the highlights and the key points are we think that just the standalone legacy Callaway Golf Club business uh, is significantly undervalued relative to today's market price of around $9.70, and we see about 95% upside from that business alone. There's a potential golf club replacement cycle based on new participants that joined in 2020 and 2021, which will lead to outsized revenue growth over the next several years. Golf continues to gain in popularity with a record amount of golf rounds played in 2024. Part of the business that will remain at the existing Callaway business is called TopTracer. It's a launch monitor subscription business that we believe is significantly underappreciated relative to what the market believes. The stock trades today around 1.2, 1.3 times my 2027 estimated sales figure, and this compares to Titleist at 2.3 times and TaylorMade at roughly 2.4 times their rumored sale price. And we see several near-term catalysts. The first that I'll go over is the Topgolf business is expected to be spun off or sold by the end of 2025 or during 2026. And then the other part is the balance sheet today looks over-levered due to the operating leases and the corporate debt on the business. They've recently closed the sale of a break-even business, Jack Wolfskin, and sold the apparel brand for $290 million, and that cap will be used to delever the balance sheet. So just to give some background on the business and how we got to where we are today, you've got two business segments. You've got the existing Callaway Golf Club business. This is your Callaway irons, drivers, wedges, and then your Odyssey putters. Then they also have golf balls, either Chrome Tours, Diablos, things like that. Your Active Lifestyle, this is their apparel brands. This is Travis Matthew and OGO. Their TopTracer business is a range golf simulator that is installed at driving ranges and offers a monthly recurring revenue subscription. Then their last piece is the Topgolf business, which they acquired back in October 2020. They previously owned about 14% of the company. They paid about $2 billion at the time of the acquisition, and they used all equity between the announcement date and the closing date. Topgolf Callaway's stock significantly increased, and the final transaction price was closer to $3.2 billion. The thesis behind the transaction was, if we can get golfers who are not very serious about the game or new to the game, and we can get Callaway golf clubs into their hands prior to them really starting their playing journey, they are more likely to go out and buy Callaway clubs when they start to play. And since there's already some familiarity with the clubs, that should drive an incremental source of revenue. Thus far, Topgolf venues have underperformed post the COVID free money era. In Q1 2025, same venue sales declined 12%. And in 2025, for the full year, they expect same venue sales to decline 7 to 12%. Recently, the CEO of just the Topgolf business stepped down to go to a CEO position at the Harley-Davidson company. So the spinoff transaction is now delayed into 2026 as they look to hire a new CEO, get that individual up to speed on the business, and then from the spin off the business. So the remaining business is going to be the golf club and golf ball business, their Active Lifestyle, their apparel business, Travis Matthew and OGO, and then the TopTracer subscription revenue. Just based on the remaining company's financials and excluding any value associated with the Topgolf business, in 2027, I think they can generate around $1.57 in earnings per share. They currently trade around 1.3 times sales. peers trade closer to 2.3 times sales, and they currently have 24,000 Top Tracer bays installed, and that's up significantly over the past several years. So the primary investment thesis is a couple-fold. First off, you've got a COVID-era replacement cycle. When you start golf, you're not going to go out and buy these high premium clubs because golf is a relatively expensive sport. Irons can range anywhere from $800 up to $2,000 plus, depending on the club and the shaft that you end up buying. Drivers, they can range anywhere from $500 up to $1,000, again, depending on the manufacturer and the shaft you choose. And wedges on average range from $160 per wedge to $200, and typically in a bag you're going to have three wedges. So if you wanted to buy a brand new bag, custom fit for you, you could be looking on the order of magnitude of close to $4,000 for a new bag. So when you start out in golf, you're more likely to buy used, cheaper, starter sets that are, just a couple $100. And then if you like the sport, you're going to then go out over the next couple of years and buy clubs that fit your game. So when a new cohort of golfers started in 2020, 2021, again, they most likely bought cheaper clubs and may not have even bought Callaway clubs. But now as they stay with the game, they're entering the period where they're going to start to upgrade their set, and that should drive incremental revenue for Callaway golf clubs and golf balls. And golf participation has continued to remain robust post the COVID surge. In 2020, there were 502 million rounds, and in 2024, there were 545 million rounds. And in 2025, that number has continued to increase. And in addition, you're also getting a new demographic starting to play the game in females. In 2024, 28% of females played a round of golf, and that's the highest on record. So that's another incremental tailwind if you get another demographic in the game. And I think one of the reasons why, and I'll just say anecdotally, I've noticed this as well. If you go out and play a round of golf, that might take on average 4 to 4.5 hours for an 18-hole round. You have a half-hour commute on both sides, so that 4.5-hour round is now gone to 5.5 hours. Say you get there half hour, 45 minutes early to warm up, stretch. You're now at 6 hours, 15 minutes, and then sometimes you'll stay after, grab a bite to eat or a drink, and now you're looking at 7 hours. And depending on your responsibilities at home, 7 hours away from the house, might seem like quite a long time. And so if you can bring your significant other or a friend along with you, and they're now included, it typically makes it a little easier to go golfing more often. And then finally, they recently closed the sale of the Jack Wolfskin business. This was a break-even, roughly, business that's underperformed post their acquisition of it. They sold it for $290 million, and this will allow them to de-lever the balance sheet a little more. And since it was a break-even business, it's accretive to shareholders. So the near-term catalysts are the Topgolf spinoff, again, was delayed, was supposed to be done at the end of 2025. Now looking like it might be closer to mid-2026. I think the thing that the market currently underappreciates is the CEO leaving likely increases the probability that Topgolf gets sold, because instead of waiting to bring in a new individual or get them up to speed, they could sell it to a private equity company or some other operator that could integrate the business and allow them to get their hands on it early. Additionally, the Callaway club business would retain an equity stake in the Topgolf business post separation, and that's likely going to take 2-3 years to sell down the position. And just history says that when you have a large seller constantly in the market, very tough for the stock to do well. So if you bring on a new CEO who knowingly has a stock option package that is going to be somewhat limited because there's always going to be a seller in the market of their stock, might be a little bit of a headwind that they could face in bringing the right CEO. The Top Tracer growth, I think there's significant pricing power that Callaway has does that is underappreciated, and I'll detail that in a bit. Product cycle, as I talked about before, just the replacement cycle. So you've got not only existing golfers that are just already in the traditional replacement cycle, but again, the COVID era, new entrants, plus the female demographic also it is coming up on a replacement cycle of clubs. And again, you're typically going to space those purchases out given how expensive clubs are. So, one year you might do a driver, next year you might do your irons, the following year you do your wedges, and then you just rinse and repeat, do that, every couple of years. And then finally, the golf business is highly cash flow generative. Combined with the Jack Wolfskin business sale, they should be able to delever the balance sheet pretty significantly over the next couple of years, and that'll make the stock screen from highly levered to levered not being a concern. So my estimates of the standalone Callaway business is that it trades at 1.2 times sales, 2027 sales. Again, this compares to 2.3, 2.4 times competitors. Top Tracer business has 24,000 and growing days. It should be steady state, high margin subscription recurring business. And then they also own the Travis Mathew brand, which is going to be on par with the likes of Peter Millar and ahead of Nike, Adidas, Under Armour. Given the fact that Jack Wolfskin just sold for $290 million, it shouldn't be a stretch to say that the Travis Mathew brand, which is a growing brand, should be worth more than the Jack Wolfskin business. Final thing, 4 insiders bought between May and June 2025. They bought about 900,000 shares, and then the CEO, Chip Brewer, added about 20,000 shares, and he owns 2 million shares. Look at the business segments. The TopGolf business currently has the highest revenue, but the club business has higher operating income, and then finally the active lifestyle business is the smallest segment. The Callaway brand is the third behind Titleist and TaylorMade. If you ask anybody in the golfing industry, they're going to, on average, say Titleist is the highest quality, premium, top of the line club, and it's primarily stems from just they are very consistent manufacturer. You know what you're getting with the Titleist golf club. They're also the most expensive, and typically those clubs are going to be reserved more towards your higher end golfer, in the sense that, if you're going out and buying a $650 driver just off the shelf, unlikely you're spending this type of money unless money is not an issue. Unlikely you're spending this kind of money if you're a 15 handicap that just goes out and plays once a week or once every a couple times a month. Just that cost just probably wouldn't make sense to you. And then TaylorMade is typically second in the brand perception. Again, very high quality club manufacturer. Again, typically know what you're going to get with them. And then Callaway is third, and they're going to be on par with typically like Ping, and then below Ping in Callaway is going to be Srixon, Cobra, and then below that is going to be like your Max Flies. And so the one thing to note though is that even though Titleist and TaylorMade may rank above Callaway in terms of brand perception, the reason why somebody goes with a TaylorMade or a Callaway or a Ping or a Titleist is typically going to come down to how they perform when they test out the clubs. Pricing, they're all relatively going to be the same. Titleist is going to be slightly more expensive, but TaylorMade, Ping, Callaway, Cobras on average are going to be pretty comparable, and I don't think price is going to be the ultimate determinant of whether somebody chooses a TaylorMade over a Callaway. It's going to be, how do they hit the club? How does it look when they put it down by the ball? Do they like the sound? Do they like the colors? Things like that. The performance of golf clubs has gotten to a point that there is almost no difference in performance, assuming you make the same swing on all of the clubs and hit in the same spot on the club. There's almost no difference between a Titleist, a TaylorMade, a Callaway, a Ping. They're all very close to each other, and no one club is going to randomly give you an extra 30 yards off the tee. They're all going to be within a couple of yards of each other. So again, it's not really about performance. It's about just what your appetite is on how much you want to spend, and if you have a brand affinity for anyone, what one looks good down by the ball for, things like that. Odyssey putters are very highly regarded in the market. It's typically Scotty Cameron, Odyssey, TaylorMade, and then a new up-and-coming putter called Lab Golf are the four main putters in the market today. Again, that's all going to come down to, do you like the weight of the putter? Do you like the look? When you're testing it out, do you make the putts with one putter versus the other? Odyssey is, again, a highly regarded putter in the space. On the apparel side, TravisMathew, again, is a premium, high-quality apparel company. Peter Millar, FootJoy are going to be the comparable companies for them. They're just the quality of the TravisMathew is maybe slightly better than your Under Armour, your Nikes, your Adidas clothing. And again, since Jack Wolfskin just sold for $290 million, company does not break out what their apparel business does. Between the TravisMathew, they also have a Callaway brand. So just again, if Jack Wolfskin sold for $290 million and TravisMathew is a growing premium apparel company, likely it's worth more than Jack Wolfskin. The Toptracer business is one that's really interesting. They've grown from 10,000 bays to 24,000 bays. And the Toptracer range is one where you go to a driving range, and instead of just hitting up a map out into an open field, this technology is like a launch monitor that'll tell you your distance, your dispersion, your spin rates. It'll allow you to play golf courses just from the bay. There's also games on the technology. And the way the business model works is Callaway gives the range the hardware for free up front, and then on the back end, the range pays $200 per month for a subscription. And based on my channel checks and understanding of the business, this $200 per month subscription has not changed since 2016. And then finally, the TopGolf business, which again is going to be either spun off or sold, it has been underperforming, and I think most investors would prefer that they sold the business. That way we can get cash in the door today, use that to delever the balance sheet further, and not have to worry about a 3-year sell down. But again, that's going to be to be determined. And again, the probability, in my opinion, that the sale occurs is more likely due to the recent departure of the Topgolf CEO. So golf has seen a significant bump in the number of rounds played post-COVID. Back in 2019, as you can see, there was just under 480 million rounds played of golf. And in 2024, there was a record of 545 million rounds played. And on July 4th alone, there were 152,000 rounds played, and that was up 13% year over year. And that's based off of Golf Now. They're a golf course management and reservation system. They're the best in the business. They're very well regarded, and many courses choose to list their tee times on Golf Now just because of their reach. And so if we look at the demographic expansion, we've got more golf rounds getting played. We've got juniors, so younger golfers. 3.7 million juniors played on a golf course in 2024, and that's the highest since 2006. Females have 8 million of them played on course in 2024, and that's a 41% growth since 2019. And again, females comprise about 28% of on-course golfers. So we've got the younger generation starting to play golf. We have a new demographic in females playing the game. Again, this should all lead to more golf rounds played, and the more golf rounds that are played is going to equate to more golf balls lost. More clubs are going to be used and replaced because golf clubs only have a certain life. To them, you can only hit so many shots with a driver or a fairway wood or wedges. Their grooves get worn out, and so from my my understanding, drivers on average are going to last around 4 years. Again, depending on how many rounds you play during the year, it's going to be higher or lower. If you play more rounds, it's going to be lower. If you play less rounds, it'll be higher. Irons, this will depend based on basically how much you like your irons. If you're improving, typically as you get better, your iron game, the irons that you play are going to change. So you might start out being a bad golfer and you want all the help in the world that you can get. If you mishit the ball, you don't want to see a significant fall off in the distance of the golf ball. And so you might start off with what's called a super game improvement. These are just really thick soles that have more forgiveness to them. And as you get better, you might go to a game improvement and then maybe ultimately to a player's iron, depending on what type of player you end up becoming. Wedges, again, the grooves are incredibly important. As you hit more balls with a wedge, the grooves wear out, results in less spin. And when you're around a green, spin is the most important thing, allows the ball to stop. So typically you'll see those replaced every 3 to 4 years. If you ask to a pro how often they replace their wedges, they may replace them once a month. Obviously, they're playing a significantly greater amount of rounds in a given year. This number, if you're a serious golfer, is probably closer to 1 to 2 times, 1 to 2 years is your replacement cycle for a wedge. In a putter, this is going to be all about how many putts basically you're making. Golfers love excuses, and when they don't see the ball going in the hole, the first thing that they think about is, oh, I need to go get a new putter because this one doesn't work, something like that. So if you're a good putter, you could keep yours for basically your entire career. If you're somebody who just is not a good putter, you may replace your putter every couple of years. All depends. And again, in 2020, 2021, based on this replacement cycle, you should start to see incremental tailwinds to revenue in the club replacement due to the new members or new golfers starting back in 2020 and 2021. So based on today's trading price of $9.70, I estimate just, again, the standalone Callaway business, the club business, Top Tracer, apparel, trades around 5 times my 2027 estimate of earnings of $5.57, 1.3 times sales. The upside, again, even though competitors trade 2.3, 2.4 times sales, the reason Titleist, AchieveNet trades that high is because they dominate the premium ball market, and the balls are typically, are basically a subscription revenue type business. Once you get started with one manufacturer, it's unlikely you're going to change unless you have a bad experience with them. Titleist dominates the tour, so they deserve a higher multiple because, again, that golf ball business is a recurring type business. TaylorMade trade is rumored to be sold for around 2.4 times sales. Callaway is closer to the TaylorMade business, but again, is inferior in terms of brand perception. So based on one-time sale, my 2027 estimate of sales, you can see upside of 70%. And again, if the Callaway business ever trades at the same multiple that TaylorMade is rumored to be sold for, it would represent 160% upside. The reason it would ever trade at 2.4 times sales is if the Travis Matthew brand really took off in the Top Tracer business, those economics started to flow through the business, and people start to appreciate how good of a business that truly is. All right. Digging into the Top Tracer opportunity, I think this is the most misunderstood part of the business. Again, the Top Tracer launch monitor gives you real-time data, allows you to play different courses, play games, makes it more interactive, informative for those that go in practice. And so the way the business model works is Callaway, Top Tracer, they give the driving range operators the hardware and technology upfront. On the back end, they sign a $200 per month, typically 3 to 5 year contract. And currently there's about 24,000 bays installed globally, and that's up from 10,000 in 2021. On the economics that this Top Tracer technology gives to the driving range operators is just, it's so high that at some point, Topgolf and Callaway are going to exert some pricing power to bring some of the economics back to them. Just to give you an example, one of the operators I talked to, they operate a 34 bay range. Their revenue went from 250,000 euros to 1.25 million in revenue, and obviously there was not an additional $1 million in costs associated with that. So, doubling or tripling the revenue base is, with no upfront capital requirement, is obviously a game changer for all these driving range operators. And so even if you double the cost from $200 a month to $400 per month for these driving range operators, it's highly unlikely anybody is going to switch off their contract and their subscription to this because of how much revenue and profit it drives to these driving ranges. Just to give you an example, at $200, a typical large bucket of balls is going to cost somewhere around $15. If you want to rent out the Top Racer Bay, which would include a large bucket, it's going to run you around $50 to $55. And so it's an incremental $40 per hour uplift in revenue for a driving range. And so at $200 a month, $40 incremental revenue, that's 5 hours to break even from this offering. On any given Friday, Saturday, or Sunday, a well-run, busier driving range will get 5 hours of rental in the first 5 hours that it's operating, and obviously thereafter, all of it is incremental profit. And so, even if the range, or even if Top Tracer doubled their price from $200 a month to $400 a month, I don't really see a situation where the range is going to say, yeah, that's too expensive for us. We're not going to do it. Those ranges, if they were to double the cost, it's more likely that range is already struggling and more likely to switch off the contract or take out the Top Racer technology because it's just it's likely just an underperforming revenue. So if you can drive basically a doubling of the price, that's obviously significant flow through in terms of profit. On the 2024 separation call between Topgolf and the Callaway brands, management disclosed how much revenue the Top Racer business did, and they said it did $45 million of revenue and $1 million of EBITDA. And for anybody that understands how a subscription business is, or a razor blade model works, there's just no chance that 2% margins are the stabilized go forward economics of Top Racer bays. I believe the reason they are so low today is because of the way the accounting treatment works for the upfront hardware costs. And as you get to a slower going, stabilized business, the true underlying economics of Top Racer are going to unfold. Steady state, I think it's possible you can get to 60 to 65% EBIT margins, but between now and then, when you go from 2% to 65% over the course of 10, 20 years, again, that is just significant EBIT profit uplift. The other interesting aspect is Topgolf. There's about 101 bays currently. All the Topgolf bays are equipped with Top Racer technology. Currently, that technology, those bays are not paying Top Tracer any revenue because it's just an intercompany technology share. Post spinoff, it is likely that Top Tracer is going to start charging Topgolf some monthly rate to use the technology. While it's unlikely that they're going to charge them the full rate, at least at the outset, there's going to be some sort of agreement that's traditional with a spinoff. Maybe it's $50 a month, maybe it's $100 a month, maybe it's free for a year or two, unsure yet. But over time, you're going to go from that underpriced contract with Topgolf to a normalized contract. And with 7,000 bays already installed, there's no cost to Callaway, Top Tracer. There's no incremental cost to them to install these bays. So again, that's a significant profit uplift. Again, if you go from 7,000 bays at, call it $200 plus a month again, at 65% EBIT margins, you can see an incremental $17 million of revenue. And that's with zero added cost because, again, those bays are already equipped with the TopGolf technology. So if you combine the two factors of both the price increase plus the TopGolf integration, in the near term, it would not surprise me if you go from that 45 million or 57 million, where I think they're at today, in TopGolf revenue to almost doubling it at 112 million. Again, stabilize margins. Maybe they're 45%, maybe they're 65%. I think it's unclear now, but the broad point is that it's not 2%. And so even at a 45% EBITDA margin, that's an incremental $50 million of EBITDA, which is, again, a 15% EBIT. Thereafter, it's 15% EBIT uplift for the business. Again, and I think that's completely missed by market participants today. So you've got a high ROIC business that's currently under monetized, that has to stabilize, it is going to be a significant earnings driver to the business. So risks that I see currently, I did a drive and I went to many different pro shops, Golf Galaxies, Dick's, just to see, what the promotional environment was like, what the inventory situation was like. And the thing that struck me the most was there is a significant amount of discounting going on, and there is a lot of inventory. On average, it felt like there were almost no club slots missing at any of the retailers that I went to. And this year, there was a very competitive launch where TaylorMade, Titleist, Callaway, and Ping all launched a new driver in fairway wood. That's abnormal. And as you get past 2025 and into 2026, the competitive environment will be less. But I think the risk that you have currently is that you're going to leak inventory, this year's inventory, into next year. And based on what I said about the performance of clubs going from last year's model to this year's model, there's going to be almost no improvement to the performance. So if you have excess inventory that's prior generations, that's just going to lead to less demand for current generation clubs. The other risk that I think is to watch is the CEO is Chip Brewer. The Jack Wolfskin acquisition paid $476 million for, just sold it for $290 million. And that was over a 7-year period. Obviously a very capital destructive acquisition. And he is staying on with the legacy Callaway existing business. Obviously, he also did the TopGolf acquisition, which has not panned out as well. So I slightly worry about his capital allocation decisions. I think the thing that gets me comfortable in the near term is that they've already said that all cash flow in the near term is going to go towards debt pay down, which I think is the correct thing. So that alleviates that in the near term. I think once you get down to a normalized leverage figure, it'll be something to reassess. And finally, again, I mentioned that the TopGolf CEO has already stepped down to go accept a position at Harley-Davidson. If a spinoff does not occur, I think that's a risk. I think it's unlikely, but just this spinoff has been delayed a couple times now. Any more delays, and you have to actually worry if it's ever going to happen. So the Catalyst timeline, how I'm going to track the investment is in Q3 2025, Happy Gilmore 2 was released. I think just anything to drive attention to golf is a net positive. You've got new club launches, Irons, I believe, by Callaway. In Q4 2025, you got the Ryder Cup in New York City, Bethpage. Again, just one of the highlights of golf. And again, when you're in one of the largest cities in the world, the spotlight is going to be on golf, and again, should drive maybe incremental revenue, but just more eyes on golf. Q4 potential sale of TopGolf that might also leak into the first half of 2026. First half of 2026, you've got limited releases, so the competitive environment is going to be less with TaylorMade and Callaway as the only club launches. First half of 2026, you got hopefully the TopGolf spinoff. Second half of 2026, I would expect, assuming the TopGolf spinoff or sale occurs, I would expect management to have an investor day to lay out the standalone go forward strategy. In the second half, you also have continued COVID replacement of clubs. And then throughout 2027, you've got TopFacer, their economics starting to flow through. Again, hopefully that's around the time you would start seeing pricing increases. And then again, continue to see deleveraging and debt reduction. So here's my estimates for, again, just this standalone Callaway TopGolf, Callaway TopFacer business. Again, it's the thing with golf is that it's typically the demographic playing it is going to be middle class and up, and their sensitivity to the economic cycle is a little less than, I would say, the average consumer. And so even if the economy were to go into a recession, I would not expect the business to be materially affected. You may delay the club purchase for a year or two to get through, any concerns, but I think by and large, any sort of economic downturn, I'm not too concerned about the potential impact to the business. And so again, the other thing to note is that during the separation call, management said that there's going to be about $25 million of dyssynergies from the separation of TopGolf and the Callaway brands. They said over 25 million is going to be associated with the TopGolf business with a net benefit to the Callaway business, which means you should see SG&A come down slightly. I also think that there are some additional costs that management is going to eliminate post separation, and so that's part of the reason behind the EBITDA margin uplift. It's also stemming from the sale of Jack Wolfskin, which was again a break-even business. So getting a break-even business out is going to be a natural uplift to EBITDA and margins. And then finally, the TopFacer business, again, as the economics of that business start to unfold and flow through the income statement, that's going to be another tailwind to the business. If you have any questions, I'd love to discuss the idea further. You can feel free to send me an email at dominic@stevens.com. I'm also happy to send you a presentation if you would like. Thank you again for watching the presentation, and hope to chat with you soon.